Happy Monday, everybody. I hope you had a good weekend. There was a lot that went on last week and a lot coming this week. Let's jump in, recap last week, and preview what we'll see this week. Last Monday, stocks opened flat as geopolitical tensions heated up. And yes, I do hate that we come up with big words to talk about the fact that we lost 3 U.S. soldiers. With no immediate response, stocks drifted higher in line with momentum, and as markets started to set up for the Fed week, the Treasury announced that they were their refunding numbers, and they were $55 billion less than expected. Thus, Treasury yields went lower, stocks went higher. Just to keep this into perspective, the numbers were $760 billion versus the $816 billion previously thought. Clearly still a long-term problem, but markets have to have something to move them. So here we go. Stocks closed near the high for the day. Markets started to brace for the Fed meeting. The Dow was up 0.5%, the S&P up 0.75%, the Nasdaq was up a bit under 1.25%. Stocks opened unchanged on Tuesday as news was all over the place, enough to confuse the algos into holding tight. Global eco data was soft, Australian retail sales, and here's that term again, better than feared, Eurozone GDP. Again, market needed something, right? So add in a bunch of company-specific news. Notable companies, GM had strong earnings, but news that should have worried markets more. UPS had bad numbers as package volume was down, and forecasts matched that as well. Eco data, IMF raised the global growth estimates. Home prices cooled, and the one that was a bit out of line, JOLTS, came in hot, back up to 9 million plus job openings. And that did catch the market's attention for a few minutes at least. Pretty sure markets are no longer putting much into that anymore. Some of the inputs have changed. Stocks did stabilize on dovish comments from ECB officials, and the real weight started. Microsoft and Google's earnings after the close, along with Wednesday's Fed meeting release and press conference. The Dow was up 1/3%, S&P close to flat, and the Nasdaq was down about 0.75%. As markets waited for the Fed, the open was mixed on Wednesday, with the Nasdaq down over 1%, and the Dow close to flat. Again, company-specific news: Microsoft and Google and AMD all disappointed in some way, and that weighed on the techs. Banks were back in the spotlight in that New York Community Bank reported a loss of close to $250 million, and the stock was down 50% at one point. Smelled a bit like last spring's bank issues, but that seemed to be a one-off for now. As is the case a lot these days, markets did some Fed whiplash on the written Fed statement and the press conference, as Powell made it pretty clear, really clear, that a rate cut was not likely in the cards for the March meeting, and that did weigh on stocks. Markets sold off into the close and finished near the lows. The Dow was down a bit over 0.75%, S&P down over 1.5%, and the Nasdaq was down 2.25%. The day after Fed Day, also known as Thursday, we had a mirror image for a bit. Amazon and Meta, strong earnings and up to show for it. Apple down after some underwhelming earnings. Overall, earnings were good, and that had the happy juice flowing. Global eco data was a bit inflationary, but markets ignored most of that and focused on the U.S. data. Productivity and costs had more efficiency in the labor market and lower labor costs, all music to the ears of the Fed. Not that they are currently worried about inflation as they look for rate cuts coming down the road. Jobless claims continuing and initial both point to easing labor markets. Again, 9 million from JOLTS. Remember that. Ignored. More conflicting good news and bad news. You can try to figure out which is which. The Fitch expects a rise in default rates versus the geopolitical news. Not sure where it came from, but ceasefire rumors in the Mideast, those were short-lived. Amazon AI releases and IMF comments about the rate cuts being likely in a matter of months in the U.S. Markets started to position for the final news of the week, the jobs numbers on Friday morning. On the positive side of the position, Dow was up 1%, S&P up 1.25%, the Nasdaq was up 1.33%. Markets opened little change on Friday after a chunk of the big news item. The expected jobs numbers was another big surprise. The number ended up nearly twice the estimates, and previous months were revised upward as well. Wages were up more than expected also. Exxon and Chevron beat expectations, but recall I've been telling you that the expectations, otherwise known as the bar, has been brought down for months, and thus they beat it over the bar. This as profits fell year over year. Chevron down 65% from the same period last year. Exxon down 40% in profits. Note that the numbers are still huge. $2.3 billion in net income for Chevron in the quarter and $7.63 billion for Exxon. University of Michigan data rounded out the week. Consumer confidence came in at the highest point since July of 2021, and inflation expectations 2.9%, the lowest reading since December of 2020. By the end of the day, the Dow closed up about 0.5%, S&P up a bit over 1%, and the Nasdaq up 1.75%. For the week, not too shabby. The Dow was up 1.5%, S&P also up 1.5%, the NASDAQ up 1.1%. This week, as I've been telling you, I think earnings will regain center stage. We'll get CPI and Senior Loan Officers Opinion Survey. We'll see some services PMIs today as well. But the key this week will be the focus on valuations. How are these earnings coming in above the lowered bar? We'll have to see. Watch for bellwethers: Caterpillar, Ford, McDonald's, Pepsi, Disney, Lilly, Amgen, Uber, and even Unilever. Now that the Fed has reported, it is time to trot out the speakers. This week alone, among all of the earnings, I'm not sure that these Fed heads will get any press time, but we'll see. Goolsbee, Bostic, Bester, Kashkari, Collins, Harker, Kugler, who's with his first speech, with the first speech since she joined the board, and there's more: Barkin, Bowman, and wrapped up by Logan on Friday. Not a record, but 10 is up there. And not to be left out, Janet Yellen may miss her Fed days, but as Treasury Secretary, she'll testify to Congress on Thursday. So that's the week behind us and the week ahead. We continue to push the envelope, and the volatility continues to be the word of the day. I maintain my opinion that earnings and valuations will take the oxygen out of the room, and that makes some sense. This seems, even as you heard Powell, if it is not if, but when the rate cuts come. So portfolios and plans need to be set for that next phase. Please come back on Friday for the planning video. I already have a few tales from the front lines to share with you. There's a lot to keep up with right now. I'll do what I can to bring you important things in the time that you give me. Remember, this Monday video is a short term, and In the Weeds will continue to focus on the long term and the plans to determine your goals and make plans to do all we can to reach those goals. I'm still doing the beginning of the year planning meetings, only month 2, but it is already month 2. Stay in touch and have a great week.